Welcome to this explainer. Look, if the mere mention of federal taxes makes you want to literally hide under your desk, trust me, you are absolutely in the right place. Today, we're taking a completely different approach. We are going to replace that annual tax dread with genuine, actual financial empowerment. How? Well, by taking those abstract, wildly confusing tax laws and turning them into a concrete visual roadmap. We're going to break down the U.S. tax system right here, making it accessible, logical, and most importantly, something you can finally use to your advantage.
Okay, let's dive into this. We've got 5 clear steps to master the tax system today without getting overwhelmed. First up, crucial federal tax deadlines. Second, the tax calculation funnel. Third, navigating AGI and deductions. Fourth, marginal brackets and capital gains. And finally, paying as you go. So starting right off with step 1, crucial federal tax deadlines, or the tax calendar. Before we even think about doing any math, we have to establish the timeline and know exactly when the clock runs out. And honestly, we need to bust the single most common tax myth right out of the gate. People think getting an extension to file your return magically gives you an extension to pay your tax bill. It absolutely does not. No way. An extension to file is strictly for the paperwork. Any tax you owe, that must be paid by the original due date, which for most of us is April 15th. If you fail to pay by that date, regardless of your filing extension, the IRS will trigger a failure to pay penalty, and interest is going to start compounding right away on your balance. So with that myth totally busted, let's look at the actual calendar for individual taxpayers and investors. Now, April 15th, that's our big anchor, right? That's when your Form 1040 is due. But take a look at the other dates here. If you've got self-employment income or maybe significant investment income, you're actually operating on a quarterly heartbeat. You've got estimated tax payments due on January 15th for the previous year's fourth quarter, then April 15th, June 15th, and September 15th. And missing these quarterly beats? Well, that is a fast track to those penalties we literally just talked about. Now, for the business owners and employers out there, your calendar is even more vigorous. Your rhythm starts aggressively right in January. By January 31st, W-2s got to be sent to employees, 1099s to contractors. Then you hit a major milestone on March 15th for partnerships and S-Corps filing their respective returns. C-Corps follow on April 15th, right alongside individual returns. Plus, employers have quarterly payroll tax returns happening in April, July, October, and January. It is just a continuous, non-stop cycle of reporting throughout the whole year. All right, moving on to step 2, the tax calculation funnel, where we go from gross income down to net tax owed. And this brilliantly illustrates how we shift from deadlines to the step-by-step math that filters your macro income down to your micro tax bill. Think of your taxes as a giant filtration system. Step 1, right at the very top, is your gross income. That is everything you make from all sources: wages, side hustles, dividends, you name it, the whole shebang. Then we filter that down in step 2 to your adjusted gross income, or AGI, by pulling out specific above-the-line deductions. In step 3, we filter it again using standard or itemized deductions to finally arrive at your taxable income. This right here is the actual base your tax rates are applied to. Finally, after calculating that and subtracting any tax credits, we reach step 4 at the narrow bottom of the funnel, which is your net tax owed. It's a highly specific, step-by-step mathematical sequence. Now for step 3, navigating AGI and deductions, which is really about finding that pivot point. So the crucial point is that we're zooming further down the funnel to examine the most critical subtotal in your entire tax calculation. AGI isn't just some random math output. Adjusted gross income is literally the ultimate VIP checkpoint for your personal finances. It is the critical subtotal that the government looks at to decide whether you qualify for a whole host of tax breaks or whether you just make too much money and get phased out of them entirely. I mean, just look at exactly how much power this one single number holds. Managing your AGI acts kind of like a domino effect. It dictates whether you unlock or block multiple downstream financial benefits. If your AGI creeps up too high, well, you lose the ability to deduct traditional IRA contributions. It also sets your medical expense floor, dictates education credits, and can even trigger the net investment income tax. Lowering your AGI is absolutely crucial. It's the ultimate key to triggering a cascade of tax savings. Once we pass that AGI checkpoint, we hit the next major filter: deductions. For 2024, the standard deduction is a bold $14,600 for single filers and $29,200 for those married filing jointly. To put that into perspective, today, roughly 90% of taxpayers simply take this baseline deduction. It's a massive automatic chunk of income that completely bypasses taxation, drastically reducing your AGI right down into your final taxable income.
But what about the 10% of folks who do itemize? Well, here is a massive pitfall you need to watch out for, especially if you live in a high-tax state. The state and local tax, or SALT deduction, is hard-capped at just $10,000. So imagine someone living in California paying $25,000 in state income taxes and $18,000 in property taxes. That is 43 grand out of pocket. But because of this cap, they instantly lose the ability to deduct $33,000 of those expenses on their federal return. It's a prime example of why itemizing isn't always the goldmine people think it is.
Let's move to step 4 and see how this builds. Marginal brackets and capital gains. This is where we look at how the math actually works.
Now that we found your final taxable income, we have to determine the exact rate it's going to be taxed at. But to do that, we have to pause and bust another massive myth. People constantly say, I don't want to raise because it'll push me into a higher tax bracket and I'll end up making less money. Guys, that is mathematically impossible under our system. The US uses marginal brackets, which you should really visualize as buckets filling up with water. Look at this setup for a married couple in 2024. Your first $23,200 fills up that 10% bucket. Only the income that spills over into the next bucket is taxed at 12%. If you earn 400 grand, you do not pay 32% on the whole amount. Crossing into a higher bracket never ever punishes your earlier, lower earnings. Every extra dollar you earn still leaves more money in your pocket, for sure. Now, what's really interesting about this slide is how the system uniquely rewards patience. When you sell an investment, how long you held it honestly changes everything. If you sell an asset you've held for 12 months or less, it's a short-term capital gain, and you're taxed at those exact same ordinary income bracket rates we just looked at, which can be up to 37%. But if you hold that asset for more than 12 months, it magically becomes a long-term capital gain, unlocking preferential rates of just 0%, 15%, or 20%. Waiting just one single day to cross that 12-month threshold can completely transform your tax liability, potentially saving you thousands of dollars. Which brings us to our final step. Step 5, paying as you go, focusing on withholding and estimated taxes. So, we've done all the math, but now we need to look at the mechanics of how your money actually gets safely from your pocket to the IRS. The U.S. operates strictly on a pay-as-you-earn basis. If you're an employee, this happens automatically through W-4 withholding. If you're self-employed or an investor, you do this through Form 1040-ES estimated payments. Basically, the IRS demands their money as you earn it. To avoid harsh penalties, you've got to meet what are called safe harbor rules, meaning you need to pay in at least 90% of your current year's tax liability or 100% of your prior year's tax. And consider this a fair warning. If you fall short, the underpayment penalty accrues from the due date of each quarterly installment, not just at year-end. You can't just wait and fix it all in April without paying a price. Which leaves us with one final provocative thought. If you usually get a massive refund every spring and, celebrate it as a windfall, I really want you to consider this question. Is your W-4 giving the government an interest-free loan? Because realistically, a huge refund simply means you over-withheld on your W-4 all year long. You gave the government a massive interest-free loan with your own money out of every single paycheck. Money that could have been earning interest for you, paying down your debt, or growing in your own investments. So, I challenge you to review your W-4 elections today, stop over-withholding, and take true, immediate control of your paycheck. Thank you so much for joining me for this explainer, and I will see you next time.